Welcome back, everybody. Time to get going. We got a lot to talk about, a lot of fun stuff going on this week. I don't know about the markets. I don't think it was too fun, but a lot of good podcasts to talk about. And I like the Quantica webinar. Very insightful, very supportive of my worldview. It's always helpful. So yeah, I've a 1 hour hard stop today, and but let's cram as much in here as we can. Oleg.
Hi everyone. Hi Jerry. Hi Richard. Hi Alp, Brian, Debonair, Jerry Smith, Marcel, and all of you. I'm very happy to be here. Of course, yes, I'm very happy to be here. I always say this, and the main reason I think why I say this, because I feel this. And the main reason I feel this, because I was really dreaming about our spaces, something like that, for more than 15 years, at least 15 years, before I took part in it first time in April 2021. So I'm so happy every time I'm here. It's I've told you, one of the main reasons this is. And I remember today when I look first time at the market chart in the mid of 2000s, 2006, 2007. I felt that I love this chart, and I loved any charts from my childhood. I loved this in math. I loved statistics and charts. And so when I saw the chart of a market, it was a fixed market, I felt that I want to be part of this. And I love the idea of being a trader. And a lot of people said that it's this idea is not naive, it's strange. There is, and in fact, there is. It's not so much traders in Russia nowadays, and in 2006, 2007, I think it was even less traders. So, and people said to me that maybe it's not, maybe it's impossible. But I believed in my dreams, and I started to be a trader. I started doing my researches, and it was very, very, very happy trip. And now I'm here, and of course I'm very happy. So, and this week, I was listening the new conversation with Jerry on algorithmic advantage. Liked it very much, and I like something. Jerry says a lot of different, very important things, as always. And for example, he said, the backtest says, as relates to your CAGR, you can expect your drawdown to at least be twice as much. So if you are going for 20, you are going to have drawdown of 40. I think it's changed a bit because we trade over 300 markets now. But you should still be ready for that and be ready for those drawdowns. And by the way, very important things to understand for us. This statistics, to understand our risk management. One of the main things is risk management. To understand our that we must be, as I always say to everyone, that if you want to be a successful trader, you must be diversified and you must be a good risk manager. So, okay, let's get started. Very happy to be here.
Thank you, Oleg. Now, thankfully, we have Richard back from his adventures down under. And I might have missed a Richard podcast with Niels. I don't know if you have anything you want to bring up about that one, if you want to talk about your latest appearance on Top Traders Unplugged, Richard, or get into some other subjects. I think you have a lot of stuff built up that you need to tell us about.
G'day, Jerry, and g'day, everyone. Yes, look, I've had a wonderful holiday. I've since sort of just after Christmas, and I've sort of got back last week, and Look, I haven't had any podcasts with Niels after that that big group event in December, but I've got one coming up in February with him, so that'll be interesting. But no, look, have been busy on the algorithmic advantage front, putting out some podcasts from the end of last year, such as yourself, Jerry. That was a great podcast. Really enjoyed interviewing you. Where we talked about, we really looked quite deeply into your turtle trading experience and then how you got involved in Chesapeake and things. And Simon and I had great fun with that with you. So thanks very much for participating in that, Jerry. Look, managed to write a few articles last week based on a couple of books that I've been reading over the holidays. One was on ergodicity by Luca Delana. That was a good short book that raises some very interesting things to consider and how they're very relevant for trend followers. And this is the principle that survival is paramount before you consider performance. So if you can survive, then it's a natural outcome that over the course of time, with the benefits of compounding over the long-term duration, you will exceed market averages, because those market averages actually include all participants and their trading behaviours, their buy and sell decisions, etc. And because those averages include a lot of failed traders and investors who meet risk of ruin, that means that those who survive naturally find that over the course of time, their results skew upward above the market averages. And that's one of the secrets of the process that we apply with our trend following process. Yes, there is this weak edge in the market that's great for trend following, but our particular robust process, risk management is at the forefront. By applying that principle and allowing ourselves to benefit from these outlier opportunities, but always strictly mitigating our adverse risk, the asymmetrical properties of that over the long term mean that over the course of time, it's highly likely you will achieve over or well above the market averages. So it was a very good book. And but apart from that, Jerry, great to be here and looking forward to this session tonight.
Pretty good. Thank you for all of that. Glad to have you back. Yeah, so might as well start with the webinar from Quantica. I really like that. I really like those guys. They're one of my favorites. I visited with them a few years ago in Switzerland, had a really good time. Tried to understand exactly what they do. Some interesting stuff that they were talking about their research process was left off of the recording. That's a bummer for all of you guys because, I listened to it live. So I don't know if I'll have to try again, or maybe they'll put it out there at another date. But anyways, the first thing that they were getting into that I posted that I thought was pretty interesting was, the strategies. They had a nice chart showing what's sort of what time frames have worked the best in trend following using their generic model, which is pretty good because it doesn't include a lot of stuff, because they're the least generic CTA that I know. I'm the most generic that I know. So I sort of agree with some of their conclusions that the look-back periods for the optimal look-back periods on trend are between 1 and 2 calendar quarters. I may go a little bit longer term than that. They took it out to 5 years, I think, which I wouldn't go that far, of course. But and I think we share the same definition of look-back period, or what that actually means when constructing a system. But longer term was better last year, and everything else sort of didn't work according to their analysis. So I thought that was a pretty interesting observation. Then they get into this idea of last year being a year where there were no sector moves. I use a different term that they were using, but more along, there was no sector moves like we had in 22, where we had the bonds moving in concert with each other. And then prior to that, possibly the dollar, everyone was short the currencies. But last year, that did not occur. And then they came up with their analysis showed that in those type of years, diversification is paramount. And when you don't have a whole sector moving, obviously you need to have some idiosyncratic moves amongst markets, your sugar, your cocoa. Robusta coffee, that's quite a trend there. I don't know if anybody's watched that. I trade 3 coffees, and 2 of them are kind of sitting there, not doing too much, maybe with a loss. But Robusta has been quite the big trend. So I thought that was pretty interesting. And my own observation on that would be that you further, and I don't know the details of their generic trend following, because nowadays generic trend following, oh my God, I mean, a generic could mean volatility and correlation managing, or one or both, right? Now it's just a given that you're going to manage the volatility and resize the positions daily, monthly, or whatever, based upon the new volatility. And but obviously, if you are cutting back on the winning trades and decreasing the possibilities of an outlier due to increased volatility, that would make it even more important to have these sector moves to sort of ensure that you're going to have a good performance. The more diversified the portfolio was, the better the performance, which explains some of the dispersion. I left out the word, he used the word obviously. Obviously, the more diversified portfolio. I have to wordsmith these tweets to get everything in. I'm a pig when it comes to using as many words as possible. But I thought this was a pretty good, I love Quantica. I love those guys. They do a great webinar. They let me attend, and that's really appreciated. Did anyone want to comment on that webinar?
I didn't see the webinar, Jerry, but look, my portfolio, I've got very little sort of fixed income exposure in my portfolio, and I certainly found in 2022 that the things that were, I got incredibly good results in 2022. That was my best year I've had since the inception of my own personal trading. And the things that were really driving that were very much the same things this year. So OJ, London Sugar, the yen pairs, they were the things that were really driving that 2022 performance. So to say that it was the year of fixed income, I suppose a lot of people certainly did benefit from fixed income, but I certainly benefited from, these commodities and the forex pairs. So I often find these research publications that talk in generics a bit difficult to swallow sometimes, because it doesn't necessarily agree with my own personal trading experience. But that was 2022. 2023, of course, we had the continuation of OJ, continuation of London Sugar. We had the fall off, of course, of the yen pairs, etc. But then when I also look at the performance of Mulvaney, my gut feel is that it was the orange juice and London Sugar that gave him the stellar performance in 2023 that gave him an incredibly dispersed return, well above that of the rest of the industry average. So they're just the things I'd comment on.
Actually, hi guys, hey everyone else. I mean, this outliers versus sector moves. I mean, which years do you remember these outliers happened and provided an uplifting power to the portfolio without there are any sector moves? Like now, Richard Brennan was talking about 2022, but in 2022, dollar was the sector move. The entire dollar, index, everything else, dollar appreciated against all of its peers. So it was a sector move there. It's not only the dollar. Almost. If you look into the long-term trend in 2022, dollar has appreciated against all other currencies like Swedish krona, Swiss franc, and whatnot. And of course, you're gonna capture that long-term trend depending on your model. So. USD JPY, surely one of them, but, I'm just thinking which, so outlier moves and sector moves, okay? So the only year that I do, the only years that come to my mind is, for instance, last year. Last year, there were no obvious sector moves apart from equity. Okay, equity has trended big time last year, But if you put it aside and the outliers that came from the equity trading last year, so there were nothing happened on the credit or forex or commodities as a sector move. So the outliers that came last year were genuine, and I think the similar thing has happened in some of the other years, but it is not often. So, usually like 2020, for instance, 2020 and 2021 was commodities has entered into the sector move mode. Okay. So of course, in 2020 and 2021, when you look into the trend following money managers, you will see actually their performance were very good from the commodities, because the commodities have trended like no other. And in 2022, this time credit trended, and then USD trended, and and then commodities turned into it's a mixed bag, but definitely that uptrend in the commodities that started from the 2020s have stopped. So when we say the outliers, I can only remember last year and maybe 2014. In 2014, this crude and Brent actually made a big time return generators. But other than that, yeah, I mean, these outliers are coming from those sector moves. So, for instance, this year, I mean, if you're not catching anything else on the equities, yeah, I mean, I think the majority of the outliers on my portfolio are going to be coming from the equities. It's just not, when there's an equity bull market, it would be, it would make sense to capture those outliers from the equities. And so, yeah, I mean, we talk about these outliers, but it is important to emphasize it scientifically and to say, okay, this outlier is a sector move and this outlier is not a sector move. And and most of the time, these outliers comes when there's a sector move, and there are very rare exceptions, I think, as I mentioned, and last year is just one of them. Thank you.
I got cut off there at the end, Al, but I do think that these when you're managed futures, when they sort of cut the tails a little bit and don't fully ride the trend, they really are subject to these sector moves. In fact, I've heard people on the podcast say the very same thing, sort of totally forgetting that not everybody is going to do that, and they're not all going to be subject to held hostage by these sector moves. So I think what has happened over my career is I can name a lot of outliers. I made 30% in heating oil, December heating oil in 1990 with a small portfolio, and I made 30% for the year. But since then, I've become very diversified, and I trade all these markets. And I do remember back in after COVID and the ensuing commodity rally, where it would be accurate to say it was a sector move, but within that sector move, there were two or three of those commodities that were star performers that vastly outperformed the sector. And if the sector hadn't have moved and it had been only those commodities, it would have been really nice profits just from those few markets. And the same thing, I think the yen is another prime example of that being a really big move within the currency sector move. And so the good thing about the outlier hunters who don't cut the profit short is they get the sector moves and they get the outlier moves as well. So I do think that I tend to underperform, in a year like last year, because I'm so diversified and I don't overtrade the bonds, and so I don't profit as much from a big sector move as relatively as people who trade a lot of bonds and they use the vol targeting, vol management to trade them larger, because I'm sure when you do the back test, you feel like you can trade larger by ramping down, and you have to trade larger because your big profits are smaller. But in a year like this, where you see the stock market is going to make money this year, probably, or has made money last year, you had some amazing outlier trades that would have dwarfed the sector move. I keep bringing up Eli Lilly, but when you have a 100 to 500 ATR move, whether it's when some of the sectors are moving or not, it's going to really stand out and dominate your performance.
And I believe, so the major highlight of the week for me is actually this short trade. So I have shorted the ADM, one of the food companies, food processing companies, this Archer Daniels Midland. And you wouldn't imagine it's just like it went into a big time outlier mode, that short trade. It's just because some accounting irregularities or whatnot. The gap down, I just entered, going down and down and down. And yeah, I mean, sure, is this a sector move? That short trade? It's a pure outlier, because there's a bull market. So anything else that happens on the bear market, is definitely not a sector move. So these things are happening. I totally agree. It's just, sometimes, you're gonna catch those outliers, but you're gonna catch the outliers within the sector move, as well as catching the outliers, the larger outliers within the sector move. So that is very important. So when managed futures are making all outliers look like the same size, my outliers are going to be, some of them are going to be huge and big winners, and this short trade is just one of them, really. And we were talking about this, using a filter, a regime filter last week, and if I would have used a regime filter of any sort, I wouldn't have caught up this short, because usually when the S&P is above 200 moving average, you would have put a regime filter, and you wouldn't take that short trade. And if you look into it, just look into the Twitter, who's talking about short single name equities at the moment? Like no one. Everyone else is talking about is long single name equities. Everyone else is posting long positions, long crypto, long single names. Who's posting the shorts? Who's short Bitcoin? I am short Bitcoin. Who's short single name equities? I'm short single name equities. I'm making money out of it. So it's good, and that's really fun, when you catch something else like the others are not posting or not trading. Yeah, that makes a lot of, it's good trading, it's good diversification, and it's fun too. Thanks.
I couldn't agree more. It's a great chart. That was according to my calculation, that move down was 6 ATRs in one day. A little bit over 6 ATRs. That's quite a move. You don't see that very often. 4 is rare. But yeah, 6.5, my calculation. But yeah, that's a great idea. I agree. And what's so silly is these markets are staring them in the face. They're right there. You don't have to get the paperwork together, set up the swap agreement, go to Thailand. No, it's right there. It's right there on your IV. Just go short it. Well, I don't know if I can do that. Is that trend? Is that futures? Is that trend following? Is that managed futures? Is that what clients want? There's a million reasons, and all you do is just fucking short it. It's right there. You're shorting everything every day in your portfolio, but you can't short a stock. Come on. And this is a big stock, 27 billion. So I've been short this stock before. Yeah. So it's not a hard one to short. There was Meb, I love Meb, and he put out a quote of the day the other day that I had to attack. It wasn't his quote. It was a famous trader's quote. He's put me up there before, and I've probably been attacked. So I had to attack this quote. and it was something along the lines of shorting is for show. Investors pay attention to longs only, or something like that. And I was like, what the
I'm
fuck?
glad you attacked it,
It's
Jerry.
crazy.
That was worth an attack.
CTAs have a huge edge because we short, just not even question it. We're likely to go short just as likely as we are to go long. And we just put that short on there. It helps with diversification, helps with safety. As Richard was saying, staying in the game, preserving your capital. That was Turtle 101. It was a long part of Turtle 101. That making that always your bottom line of staying in the game and preserving capital. And then, this quote brought up investors. Oh, investors don't, short, because we're above that. We're the country clubbers, the prep boys, the prep school boys of investing, because we're investors. All you low class shorters, what a bunch of crap that is. Somehow the speculators, the evil speculators, are diversified, maximally diversified across the board, taking short trades for safety and diversification, using a stop loss, using a trailing stop, and using money management, hopefully very infrequently, but whenever necessary, to reduce positions and cut back and to stay in the game. And we're the bad guys. Hello, Moritz. How are you?
Hey, Bunch. Doing great. Actually looking forward to flying to the US and hopefully seeing you, Jerry, next week in Miami. No, all's good here. I like the Quantica presentation, but we don't have to go into that again. I always like their charts. I think their charts are nice. I wanted to ask you, Jerry, about the third coffee market that you're trading. That I must have missed. So I'm trading Robusta, which is in an amazing trend and really different to the US coffee market at the moment. So there you go, right? Trading these markets which are correlated most of the time, but then every once in a while here you have the example they're not that correlated, and you can actually get that diversification benefit by trading the additional market. Guess what was most interesting about my week, the back and forth and the trading and all that, and some CTAs, some trend following traders have had a relatively good start to the year, some not so much. So I did do this podcast with Baumor, UK-based trend following fund. I had never heard of prior to last summer, I think. I never knew of their existence. They produced some great returns last year. Not Mulvaney style, but maybe a second or third place behind Mulvaney. And they trade very few markets, 21. So I did this podcast with them, and it's probably, I hope it'll come out next week. I hope you guys will like it, because I guess it's the most detailed, or shall we say almost technical podcast that I've ever done. It just happened that way. Niels emailed me afterwards. He wasn't too happy about it, I guess. I don't know. But so these guys are up 9% month to date in January because of palladium, the topics. I think cocoa. Yeah, of course, cocoa. Everybody's long cocoa. And so we went into all these things about, trading these very few markets, 21 only, and why this could be possibly better and less dilutive than what it is that I do or that Jerry does. And, we like trading these many markets. So we had, it's been a very polite, very nice conversation, but obviously I had to politely push back on that stuff and challenge them with questions. So we couldn't really tie it up. And we also got into this dynamic position sizing stuff, which I thought that they wouldn't do, like, vol-based, correlation-based, whatever, the things that we don't do, but which many other trend following funds, especially the large ones, do. And so, and then he said, we do dynamically adjust positions based on the ATR. So ATR volatility measure, right? So whether you're adjusting or, dynamically adjusting your positions based on a more recent ATR as opposed to not doing that, or whether you use volatility, probably at the end of the day you get the same result. But the argument for why they do that is they think they have these trends in their 21 markets, and when these trends start to materialize, they will be on that trend. But on any given day, they want there to be a noise cancellation, is what they called it. So you want these uncorrelated markets to essentially cancel each other out if there's nothing going on from a volatility or ATR perspective. One market, gains a little, the other market loses a little, and so you have that noise cancellation effect. And again, it was so interesting because, honestly, I think if you cancel all the noise, you'll also cancel the big outlier move in either direction eventually. I'm pretty sure about that. But who am I? These guys are up 9% in January, right? So it's anyway, I'll stop here. I hope you guys will like it. Give us some feedback on it or comment on it. I think it's one of the maybe and hopefully more interesting chats I've had with these folks.
Maurice, what? Just a quick follow up. What is the return drivers? You said they are 9% up. What is the return follow?
Yeah,
Thanks.
yeah. So palladium, cocoa, and topics is what they've mentioned. These three markets is what made their returns. It's on the podcast as well. Niels was telling me that we should never really mention any of these numbers, and I think he's right. Like, regulation, all that type of stuff. But the podcast isn't regulated. If anything, it's really probably their issue that they brought it up. But they were so jazzed about it. Like, the conversation immediately started with, hey, we're up 9% in January. And that is that it is because of these three markets, and essentially the only market where they called it an offside position is natural gas, where they had sitting on a small loss. But all the other markets, they were in the green with large gains, such as cocoa, topics, and palladium, or smaller gains, such as some of the other markets I guess they trade. And I'm not sure how large. That was really interesting. I didn't ask that. I didn't want to be, too challenging or impolite. But
I mean, it's very curious that you mentioned. I mean, it's just, I'm just a little bit puzzled. You're saying 21, but you're naming cocoa. For instance, cocoa is very, it's not your, main 21 markets. I mean, if you're gonna trade, indices, so these guys are not possibly trading a lot of indices. I would guess, right? Do you know?
Well,
Do you know?
well, they trade indices. They trade the topics, the Dow, and the Eurostoxx, three equity index markets. The way they built their market universe, they call it mutually exclusive, collectively exhaustive. They have three equity indices. They have three bond markets. They have three FX markets, and they have three softs and three metals. So palladium, gold, copper, I think. They have three energy markets: crude, nat gas, and heating oil. Three softs: cocoa, sugar, coffee. Go through the list 7 times 3, 21, blackjack. It's just, they trade 16 models. So this is they call it smart pyramiding. I don't think that's pyramiding, and kind of like what some people would, or say, old school traders would call pyramiding, in this, like, where you have a position that is showing profits, and you would essentially press it and become larger in that position that already shows profit, like add to a long position because the long position is ahead, and become bigger and bigger and bigger. And so that would be a form of pyramiding. Their way of pyramiding is essentially what happens when you trade a multi-system approach, an ensemble of strategies, and you add them together. So you have 16 different trend following systems, 4 different types across 4 different speeds. That's 16. And when you trade all of them, you can eventually have 16 positions, because each of these systems is run independently. And they were saying that in Palladium, they have each system fully loaded, or each system is loaded, and therefore their portfolio is fully loaded in Palladium. And since palladium, no futures contract can ever be fractional, at least not yet. Maybe at some point they'll invent that, but for the time being, it's, the minimum you can trade is one lot. You would have to trade 16 palladium contracts, and palladium is a big contract. I'm far away from trading 16 palladium contracts. So I'm not sure how exactly they take the risk, but they say, yeah, palladium is the big thing that has made them a lot of money. Yeah, I hope you guys will like it. Let me know what you think when it comes out.
I liked it. I tweeted some of the quotes, and I'm trying to find them, but I'm not going to find them. But I can remember pretty much what I thought about that podcast. And number one was, okay, I'm going to give up trying to find it exactly. But number one was they said something on the podcast that made me change my Twitter bio. That's right. It was so profound that I put it up there, and that is vintage retro. Yes, they sucked me in on this vintage retro classic trend following. And then, like you said later in the podcast, no, it is vol managing or correlation managing. And so I was like, what? Vintage retro. So, oh yeah, that's when I posted this picture of, my friend came over one day and he showed me his new car. Okay, so I'm in my 60s, okay? And I lived in the 70s, wonderful time. And he shows me this car, it's brand new, and it's a Mustang. Yeah, it's a Mustang. Now look at it, it's not a Mustang. I said to my friend, this is not a Mustang. Mustangs don't look like this. This is a box car, and they threw the label on there. Yeah. So in 2024, you just have something. It's not what you think it is, but if you slap a label on top of it, bingo, you have a Mustang. And you vol manage and you correlation manage, just call it vintage retro. And that's vintage retro. No, it's not. Well, who are you, Jerry, to say what is and what is not classic and vintage and retro? That's true. Who am I? Okay. So, but we use this as a basis for argument, and it keeps popping up everywhere. Okay. So I was posting a lot of good stuff about it. And then I had to bring up this whole idea of how they tricked me, and it's not, in my opinion, vintage and retro at all. And but then those guys from Bowmore were liking my tweets and being friendly to me. So I like them. They seem really good and they seem talented, and really something interesting to talk about. So, and they didn't get mad at me for posting the stuff about vintage retro. But I think when you have a situation where you're going to focus on so few markets, and I think what they have, and I love that other term that you mentioned, I tweeted that as well. But when you have so few markets that you're willing to trade, it's almost obvious that they're going to vol manage because it's not going to really matter as much. And so they're intensely focused on this correlation idea, which we're not. We have more diversification than anyone else, but we're not that focused on the correlation aspect of it all for correlation reasons, for smoothness reasons. And so they are very focused on that. So you have these 20 markets, that's all you need. Arguably, I think that's kind of probably correct. Why have more than one currency when you can just trade a handful of currencies and you're going to vol manage them anyways. And you're going to cut back. The yen is not going to have the opportunity to be this big outlier. Now, when cocoa takes off and has these tremendous runs and you reduce the volatility in cocoa, at some point, the trend is so strong that you can't even stop it. You can't even screw it up as much as you would have to make it a trade that's not making money for you. And of course, when you're running this back test and the back test is reducing the position based upon volatility, you're going to lock into your system trading larger. Of course, we have to trade larger. It's safer. We're getting rid of this risk. We can trade larger. So at the same time that they're cutting back, they're kind of trading larger than I am, for instance, or I would by not doing the volatility cutback. And but the downside is, where does that risk go? Well, that risk goes into your capital losses. If you're going to trade larger, you're going to have bigger losses. And transfer that we trade smaller, our losses are smaller. We transfer that risk into open trade profit. But yeah, I think it's interesting, and I think if you wanted to just concentrate on smoothness and daily smoothness, then yeah, if you trade a representative sample, not too many. But of course, they didn't comment on the inconvenient fact that for us, we don't get any downside from trading all these markets as long as what we continue to say remains to be true, and that is it's 5 to 10% of the trades we do are outliers each year. And as long as that continues to be somewhat true over time, then there is no downside. In fact, adding more markets, as Quantica said, and as we've said here many times, adding more markets when you're letting profits run with no volatility and correlation management, that is pretty much the only way and the best way to get this uplifting and get this smoothness and have these outliers that we're hunting, which they're not hunting, spread out over more of the data. And so you don't have all this bad luck.
There's a couple of things which I think you have to look through when you look at these returns, for instance, from Baumor, and that is, don't get blinded by a lack of sample size. So when we look at Mulvaney, for instance, Mulvaney is around since whatever the late 90s. It's 2024 now, so he has a long track record, and you can just look at these numbers and they speak for themselves. They're great. When you look at a firm such as Baumor, they launched their fund in August of last year. They're trading 21 markets. I have a system here at home. We know where I trade on a test basis the Mulvaney markets. I trade the Baumor markets. I don't trade exactly their system. You will not have a lot of sample size. You will only have, a few trades that happen in a given year, and it's not going to be thousands. So there's a risk or a probability, a very large probability, I would say, that what you're looking at may just be a lucky streak. Maybe they've had a lucky streak, and I'm not criticizing them. Gareth and actually like chatting with them. I'm sure they're smart. I mean, they're nice guys to talk to. But it might be that they had a lucky streak in the second half of last year, and what we've seen from the Quantica charts. It was tough, but depending on the time frame that you traded and the markets that you traded, if you had like this lucky selection, that lucky basket of markets, you can have a great year. Whereas for traders that are so diversified, like ourselves, with that large portfolio and all these many markets, it would have been very difficult to impossible to escape and produce something that looks like Mulvaney or Baumor. And the same is true for January. So I don't want to beat myself up. It's kind of like, somebody else is up 9%. Why am I not up 9%? Well, let time go by. Let's see how that looks in 3, 4, 5 years down the road, once the statistics play out and the edges really come through. And I'm really convinced that trading more markets is better. And the other thing is, you will probably hear this on the podcast. I guess it's going to be released next week. Whether you I put a lot of thought into this, and Moritz and I were still working on the paper, which we're hopefully be able to share in the not too distant future about vol control and all that. And no matter, I put so much thought into this. When you adjust your positions based on volatility directly, well, obviously you're responding to volatility. If you do it on a portfolio basis, you have correlation effects in between. We looked at other things, no matter what you do, whether you respond to, for instance, or whether you cap your exposure at a certain level of margin to equity. Well, margin to equity is a function of volatility. Your brokers will adjust margin to equity or your margin requirements based on volatility. If you use value at risk, like Dunn is doing, it is in a second derivative the same thing because value at risk responds to volatility. When you're using the average true range, same thing. When you use what they are doing also, like a heat measurement in the sense that you're taking the distance to stop and you calculate a fully stopped value, well, tendency is that if you have a strongly trending market, to the upside or to the downside, and that creates a larger gap between the current price and your exit. That is because volatility has expanded in that market. So if you use this equation, then hiddenly you're also responding to volatility. Whatever you do, you will always respond to volatility, and that just has consequences. That is not free of charge, and we will look at all of these things. But I haven't found a single so far dynamic position sizing technique that wouldn't respond to volatility, even if on the surface they say, oh, we're not vol managing. Well, if you're var managing or heat managing, you're kind of like vol managing anyways.
Yes, but last year, what happened is now, there are a few people, speaking here, but what about the correlation, when you look into the, managed space, the managed futures space, managed futures performance on the, the medium to long-term traders, last year. So is there anyone else on the trend following space that is, less correlated? What about the correlations? I'm not saying that the returns, who's higher, who's lower, but are there, as a result of the work that Moritz that you're describing, are there any years that the correlations are decoupling from what the managed futures are doing? Are there any evidence that actually you're able to separate your work? You're saying fund management, money management, but I'm saying your work, your fund's work, your life's work, right? This is what we are talking about. Are you able to separate it in terms of the correlations, and are you able to say that when these guys are actually doing higher or lower, my performance goes higher or lower historically because these historical returns are available, and I think it is all coming to that. How is the correlations are looking? Thanks.
I don't have an answer to your question yet. Hopefully, I'll have one at some point, but I can't really say anything about that yet. I think the effect that we're looking to very objectively demonstrate is by doing a very clean back test. We'll clearly give out the rules, and we're not just using one system. We'll be using many systems so that nobody can accuse us of, oh, you've picked whatever a 180-day breakout system, and that just happens to be the system where vol control doesn't work, and you would have outperformed without the vol control feature. But if you use the 200-day breakout or a moving average crossover or regression slope, then it turns around. No, we want to look at many different time frames, many different system types, many different techniques to control volatility or dynamically adjust position sizes on the portfolio level, on the single market level, on the portfolio as a whole, all of that type of stuff. So that will be thousands and thousands and thousands of runs that we'll do in a very transparent way. And we'll use realistic trading costs and slippage and like all of that type of stuff. And the end result will be, at least the indication is that if you don't do the dynamic position sizing, and if you look at every trade kind of like as an encapsulated closed bet that you initiated and you let it run, it is its own thing that goes from start to finish, and you're not interfering with it other than rolling the contract. That very clear, consistent, classic style of following a trend will have superior trade stats than the dynamically adjusted portfolio. It will have better and higher skew. It will have less trading cost. It will have larger average gains, importantly, per trade, and more exposure to these outlier trades. It will have very likely higher drawdowns and volatility. if this is what you care about, but volatility isn't risk, at least not to me. Losing core capital is risk. And volatility is not a penalty, it's an inconvenience that we have to go through to get a bigger bank account. Yeah, so that's hopefully what we'll be able to show, but we're not completely done with that stuff yet. But really, there
Ritz,
aren't. Yeah.
Ritz, I think all of that is true, and I think that's certainly been my research conclusions. Is that and essentially, I think it certainly falls under something I say often, which is you cannot improve the core system. And the core, this one entry, one exit, and a stop loss, it cannot be improved. So, but what you're asking them to do is something they cannot do, which is turn their back on their statistic training and say, because boy, you glossed over this big, huge issue. And that is what I'm asking you to do is ignore what happens between entry and exit. What? Never. They will never do that. They can't do that. You're asking me to ignore sharp matters. Volatility is risk. So you're going to be able to prove what you want to prove. But it's not going to, change too many minds. Yeah, we'll change some minds, of course. Some people will have the scales lifted from their eyes, but not that many. One of the things when Rob did his from a correlation and volatility managing point of view. And so he came to the conclusion that it's a good idea to correlation and volatility manage. But you're going to start from our point of view, one entry, one exit, and a stop loss, and starting adding crap to it. And so that'll be refreshing to see it from from what we would say, a more fair vantage point. I got to sign off in 5 minutes, and I'll make some people host, so you can keep going if you want to. If not, you can just sign off. But I wanted to get back to the Bowmore, and that is, they said in the podcast when you asked them how was last year, and they said last year was bad for us as well. And so I just wanted to, I think I heard that correctly. And but you brought up another subject that's very intriguing. I wanted to go off on this a little bit and pose this question. You bring up the sample size issue. And so if I was going to do what they do, and I was concerned about this sample size issue as you described it. I agree, and I understand how you described it. So, and I would be concerned as you were insinuating. So, I would say to myself, well, we have two issues here. One issue is which systems am I going to trade and my sample size. And then issue number two is I really don't think I need to trade more than 21 markets. Okay. And so how can I have both of those? Well, I would, if I would, and I wouldn't do this, of course, but in this situation, I would say to myself, I'm going to research hundreds of futures and hundreds of stocks. And I'm going to have a tremendous sample size because I'm going to use that as my test period. And this is how I'm going to choose the systems. So now I know I have robust systems. I know all trades have the same, all trend following systematic trades have the same expectation. Now I'm not going to trade all those hundreds of markets. I'm going to trade 21. But I'm going to take the research from those 100, 200 markets, and I'm going to apply it to the 21. So I will say I have a robust system for these 21, even though it did not come, I did not decide on the systems to trade only based on these 21. I like that idea. What do you think?
Yeah, I fully agree. By the way, you sound like the podcast has been released already. I don't think maybe I've missed it. Maybe it's out already. I thought it was going to be next week. But look, these 21 markets, it suffers from sample size scarcity. I just don't like that. And there, like I said before, I think there's a great probability that it's just having a lucky run and that they may have the opposite at some point in the future and we will be more robust. So That's what I have to say. That, oh, another thing that came to mind when because you've mentioned these obviously TAs, PhDs, they can look away from their statistics and their training. You know what? I don't want them to change. Let them vol control, vol manage the hell out of the thing. Hopefully, that's going to be to our advantage. I hope that we'll be able to show that we have a better and more resilient approach to that. And if that is true, then we should have the upper hand in the long run. And if they vol manage, then let them do that. That's good for us. Maybe there's a way for us to even benefit from that. But I guess what's going to be tough for them is to make a U-turn on all their communication to their clients, that they're so smart and clever on this portfolio management technique of dynamically adjusting risk and taking, keeping their finger on the button and managing it all that type of stuff. I just want to, hopefully they'll be able to attack our analysis in the paper that we'll write, and then we'll have an honest discussion about it. But if not, I mean, at some point there needs to be a resolution to that, I hope. And they can attack the data and the statistics that we'll produce or not. But yeah, that's it.
Yes, I like this very much, really. Appreciate this, because I think that I have done from maybe 2011 or 2010, I have done tons of research, and it was on the topic, do I need not to ignore? It was one of the main topics for me, not to ignore something between exit and enter, and all my research showed that I need to ignore this, that one, like Jerry said, one entry, one exit, stop loss. Yes, is the best way. And I have done plenty of research, really. And when I have heard this from Jerry and from Moritz, I was very happy that I was right in my research, that I don't need any vol managing, vol targeting, or something like that. And really, I did not find, for me personally, I'm talking about my own experience, I didn't find any evidence that I need to do this. So I don't need to vol manage and do something like this. I want to be a classical trend follower.